Okay, let's go. We are in our third session, which is great. Congratulations for everyone that have still stuck in, and to all of the new people who have just come in as well. I really do hope that you've refreshed yourself with all of the content that was discussed in the second session. And unfortunately, as I said in the group before, I wasn't able to record the first session, but hopefully with the PDF resource that you've been receiving, that should give you a bit of an understanding in regards to the basics of the markets, the financial markets. So if you do have any questions, just put it into the group chat. There's a lot of experienced traders in the group chat. I think a couple of them are even on the call as well. So if you have anything that you'd like to know the answer to, just literally put it in a group, and I'm sure people will assist you with that, and we can go from there. So today we are on our technical analysis. So as I mentioned to you guys before, there are three core pillars of trading. We've got the fundamental analysis, we have the technical analysis, and the psychological part. Technical part is what we'll be discussing today. Today, we're going to focus on the basics of the technical analysis. Now, one thing that's very important for everyone here to understand is that when I speak through the technical stuff, it's important to understand that whether it comes to candlesticks and price action, support and resistance, trend lines, order blocks, chart patterns, everything needs to be used in conjunction with all of the other forms of analysis that we will be looking into over the next coming weeks. So you're not going to use any of them exclusively by themselves. It's all going to be used all together to kind of create like a powerhouse tool of analysis. So let's start. So we are going to start with candlesticks and price action. So what are candlesticks? Now, a lot of what I'm going to be showing today will be via my charts, because that's the best way for you guys to really visually understand what it is I'm talking about, and for you guys to have something tangible and visible to see as we're discussing. So you're going to see me doing a lot of back and forth between charts and the presentation deck. But if you bear with me as I go back and forth, hopefully everything should be smooth running forward.
Just quickly on charts, Bentley, do you use TradingView or is there better platforms to use
Trading
or
View is the best
recommend?
platform. Trading View is the in my opinion. Trading
Yeah.
View is the best platform by far. It's better than MetaTrader 4. It's just got so much different features installed within it that you can, if you use it properly, it will definitely give you a lot of insight, and it will allow you to trade efficiently, I would say. So if you can go with it, first 30 days is free. After the first 30 days, you will need to pay a subscription. And depending on what sort of advanced chart settings you like, will determine how much you would need to pay for your monthly subscription. I usually buy it annually because annually does work out better than month to month. So I would advise that wait to kind of Black Friday or Cyber Monday sales. They tend to have like a lot of really good deals coming up around then as well. So like 70% off, stuff like that. So yeah, definitely bear that in mind when I'm doing the charts. Now, the chart which I am going to show you guys isn't going to be on TradingView for today, unfortunately, only because mine is down at this moment of time. But it will still be able to show you guys exactly what you should be looking out for when we are discussing our technical analysis. Perfect. Everyone should be able to see a chart. As I said, this is going to take up the majority of our session for today. So, what is a candlestick? It's very important for everyone here to understand exactly what a candlestick is, because the candlestick is what allows you to understand what is going on in the markets, whether people are buying or whether people are selling. So, we have two candlesticks. One represents buys, the other generally represents sells. If you guys can see here, the red candlestick is what represents the selling price action that's going on in the markets, and the green candlesticks are what represents the buying that's going on in the markets. Now, where it gets a bit more sophisticated is these candlesticks that you see here, which are currently, or let's just say, let's go from what time is it today? So let's go into so this is a daily, right? So if you guys can see, we've got this green candlestick here within the daily time frame. So this green one right here. So that's a buy for the day. So right now, I'm showing you guys we have different intervals. So in the markets, you can trade different intervals. You can trade on a 5 minute time frame, 1 minute time frame, 15 minute, 1 hour, 4 hour, 12 hours, daily, weekly, monthly, yearly, whatever. Now, the time frame you choose to trade on will all be based on what type of movements you're looking out for and what type of trader you consider yourself to be. Whether you consider yourself to be a scalper, an intraday trader, or a long-term swing trader. All of those variables will have an impact on the sort of intervals and the time frames that all of you guys are going to choose to trade. So right now, as I said, we are looking at the daily. So let's take this green candle for example. This is a buy, as you can see. Now, this is Friday, the 1st of August. There's this little date right at the end of this chart, as you guys can see here with my arrow. Friday, the 31st of August. Now, if I go down into the 1 hour, what you guys will be able to see is, so I'm gonna have to scale all the way back, is this here. So within the whole day, there was a lot more buying and selling going on. So Friday, the 1st of August, from 1 a.m. in the morning, you can see a few green candles, a red candle, a few greens, a red, some red candles, green, red, and a huge green. And then it kind of stays within the green zone, within this zone, once we've got that huge green. Now, what that is showing you is that within the big time frames, with what you can see is a buy, but if you scale down into the smaller time frames, what you'll be able to see is that there's a lot more activity going on throughout the day. So if I was a day trader, I could potentially be trading all of these sells, all of these buys, all of these sells and buys before this big buy goes on. If I was a long-term trader, I probably wouldn't take much notice of all of the activity that's going on within a 15 minutes, 1 hour, unless I'm looking to use it as a form of entry to go in for the buy. So it's very important for all of you to understand that what you might see on the daily is going to look very different on a 1 hour. And if I go back, if I scale down again to the 15 minutes, so what you can see here, so this is the 15 minutes. If you was a scalper, you might have been taking advantage of those little cells there. You might have gone in for the buy. You might have taken more advantage of those cells there. So some scalpers may not necessarily be paying too much attention to this. But the great thing about what you guys are going to be learning, which is called Elliott wave theory and pattern identification, is that you're potentially going to be able to take advantage of all of the small moves as well as take advantage of the massive move that will come throughout the day as well. So the whole purpose of this is for you to really understand what is happening from a long-term perspective as well as a short-term perspective. So whilst you are trading the buys and the sells, at least you know, based on the insight that you're looking at from your cross time frame analysis, that there's potentially a big buy that could be coming up soon at some point in the future. The core basics of candles is if it's red, there's selling going on, and if it's green, or in some cases, depending on how your chart looks, it means that there's buys going on. Now, there are different forms of candles. Some candles indicate a bit of a bullish momentum, whereas other candlestick formations may indicate a bearish momentum, which is sell. So bullish means buy, bearish means sells. So what you guys can see, so we have different forms of candles, right? Loads of different forms of candles. We have candles that come with wicks, candles that's known to be bullish engulfing candles or bearish engulfing candles. We have candles what's called pin bars or dojis. There's so much different forms. I sent a resource PDF in the course in the course group literally yesterday for everybody to reference. Within that PDF, that allows you to understand exactly what every single candle represents. So by understanding what a candle represents, that will allow you to understand whether something has got more potential of going up in terms of a buy or going down instead of a sell. So we're going to start with a basic form. So we've got a candle that's called a doji. So what a doji is essentially, I'm going to use trading view to start drawing. One sec. So dojis usually look like this. You've got the wick and then you've got the body. So this is what is what's considered a doji. Now, generally speaking, a doji indicates either a reversal or some sort of indecision in the markets. So what I mean by that, if you see a lot of selling pressure, so these candles are selling basically. That's a, those are red candles, generally speaking, it's moving more within a downtrend more than anything else. Now, if you can see, after all of that selling activity going on, you've got this candle that's popped up. This candle right here, it's a little green candle here. This is called a doji, specifically a dragonfly doji. Some people may call it a pin bar as well. But what that doji means and what it represents is that we're selling, but there's a bit of indecision going on. And because of the indecision that's happening, we're now going to potentially do a little bit of a turnaround. You guys can see more dojis here. So here, if you see here, this is another doji. So if you look at here, hopefully you guys can see that represents indecisions that's going on in the market. As you can see, we're buying, you get a doji, it goes back down again. We could literally scroll through all of our different charts and we can see dojis pop up everywhere. But what that generally means is that if you see a doji, we're going to get some indecision and we're potentially going to go in the opposite direction. Now, it's important to realize that if you see a doji here, the price still continues to go up. So that's why I said at the very beginning, we have to use our candlestick formation in conjunction with everything else. I do not believe, and I would never recommend anybody trading purely of candlestick formations because you're going to get some candles that might look very, very promising, very bearish or very bullish, but because it's not aligned with your wave theory that you've identified or your pattern or the correction that you're currently trading within, that can literally be the make or the break of you losing your account or having a unnecessary trade. So everything needs to definitely be done in realization and in conjunction with everything else. So aside from a doji, we also have what's called a bullish or a bearish engulfing candlestick. Remember, everything I'm talking about, it might sound a bit overwhelming or a bit quite a lot of information to digest, but the whole reason and the whole purpose of me sharing the PDF with you guys is so you can go and refer back to it when we finish to make sure you become a little more familiar with these candlestick formations. So here is what we have. This is what is called a bullish engulfing candle. What a bullish engulfing candle is basically you have loads of small candles and then you have one big candle which basically engulfs the whole of the candles that happened previous to this candle here. So if we have, let's just say, a whole load of buys here in this area here, and then we have one big bearish candle. That's what's called a bearish engulfing candle. It basically engulfs or overshadows all of the candles that we saw trading prior to that candle. Now, as you can see here, we have a bearish engulfing candle. It kind of went up again. We had another bearish engulfing candle again. But as you can see, if you look at the bigger time frame, we actually went up for a bullish engulfing candle. So anyone who saw that bearish engulfing candlestick and said, "Oh, let me sell, sell, sell," if you're not bearing it, if you're not taking into consideration all of the different intervals and all of the different degrees in which you're going to be trading, as I said to you, it could potentially end up with you taking unnecessary trades, not realizing what's going on in the bigger scheme of things. So always, always, I will always say this, focus on cross-referencing all of your different time frames. As you can see, based on the analysis that we've got here, with this engulfing candlestick, price continued to respect this candle what went on, but as it respected this breakout here, price now continued to go to the upside, as you can clearly see. So since it actually broke out of that point with that bullish engulfing candle, it hasn't actually been back down towards that point for a long period of time. As a matter of fact, it stayed above that area. Now we've got another candle which is called a pin bar. So a pin bar is basically a candle that indicates a very strong reversal. So if you're trading and you see a pin bar, generally speaking, that's a very good sign that we're going to get a reversal. But again, like I keep saying, always make sure you are comparing your candles with all of your other forms of analysis as well. I want all of you guys to refer to the PDF document that I've posted as well. And I want to make sure that everything I'm saying, because what I'm saying is going to be a bit hard for you guys to pick up whilst I'm scrolling through the charts. So whilst you look into the PDF book and you familiarize yourself with everything, once I post a quiz into the group, that will help to identify whether you guys are able to remember all of the content that you're consuming from the PDF cheat sheet guide for the candlesticks. If we look at this, we have our candlestick formations, but the most important thing we need to consider is what is happening in context with the candles whilst they are forming in the way in which they're forming. So when you guys are looking at your candlestick formations, you are always going to be looking at the trend line as well. You're always going to be comparing or combining your candlesticks with the trend that the price is currently trading in. If you are looking at candlesticks and combining with your trend line, support and resistance and your Fibonacci tool, all of these things should help you to become more accurate with the trades in which you identify. So the next thing we're going to discuss, which is going to work alongside our candlestick formations, is going to be support and resistance. So with the support and resistance, basically what it helps us to do is identify the areas of support within the markets and the areas of resistance within the markets. Generally speaking, once we can identify key levels of support and key levels of resistance, all of these things in conjunction with the candlestick and everything else I'm going to be talking about is what allow our trades to become a lot more accurate. Now, what you guys are going to be using to identify your key areas of support and resistance is what is called Fibonacci tool. So with the Fibonacci tool, I'm not going to discuss it today. We're literally going to be looking at the basics of support and resistance. But the Fibonacci tool is what allows you to understand is areas in which the price is potentially going to reverse or areas in which the price is potentially going to continue. So when we're looking at support and resistance, what we are basically saying is that once it gets to a certain area of threshold, we are expecting the price to rebound off that point. So generally speaking, when we're looking at support and resistance, you want to look at your longer time analysis. You don't really want to identify areas of support and resistance based on your 1 hour, your 15 minutes. You always want to do it on a minimum of a 4 hour, a daily, or anything above that. The more you can identify key areas of support and resistance based on a longer time frame is generally speaking the more that will hold. Support and resistance that you identify on a 5 minute chart or 15 minute chart, that can be broken through quite easily because as I showed you guys before, a lot happens within every single 15 minutes whilst you're trading. So it's always important to scale out to a longer time analysis. So if you can see here, this is the price. We've got different areas in which the price has gone to. Once we see where a price has rebounded off a area of support or resistance, we're going to put a area of reference, which is a horizontal line, to help us indicate what potentially will happen should price go back to that point again. This is the weekly analysis for GBP USD. When GBP USD went all the way down to this point here, because it came down so strongly or so impulsively and it rebounded, it corrected, this would be a key area of resistance. So resistance meaning if it goes down and it bounces, that is now an area in which it's potentially going to hold in a longer time frame. So if we see that as an area of confluence, what we want to do is make sure we identify that, put our horizontal line there, and make sure we've got that as a point of reference so we can understand what would potentially happen if the price went back down there again. As you can see, from that point onwards back in 2009 up until now, it's not really respected that as much as we thought it would have respected that. So you also want to look for other areas of support and resistance as well. So support and resistance, if I identify more lines, it's kind of seeing where the price has respected that area and it's bounced off that area. So here, since it broke through it, And since it come back into that area there, once went back down again, meaning it's bounced from that area, we would now see this as a zone of support. So we are saying to ourselves, if it comes back up to that area again, we're now looking at for a potential, not indefinitely, but a potential for the price to potentially bounce off that zone and come back down. But again, we are making sure that we're looking at all of these different forms of analysis in conjunction with everything else that we're trading. Now, I would always say to people, make sure you're using your Fibonacci tool and make sure you're identifying your zones. So once the price does go through a certain zone, you know that whatever was a resistance is now potentially going to become a support. And that would only be done through the Fibonacci, which we're probably going to do either next week or the week after that. Don't get into a habit of putting lines everywhere on your chart. Because if you start putting lines on your chart, what's going to happen, number one, is that it's going to become very messy. Because some people literally trade like this. They say, oh, it bounced off this area, I'm going to put a line there. It bounced off this area, I'm going to put a line here. It bounced off this area, I'm going to put a line there. And what happens is that your chart now starts to become very messy and it starts to play with your psychological part of your brain whenever you're trading. Because what you're going to say to yourself is that, oh, if it comes to that point, it's probably time for me to come out of my trade. Not realizing that there's so much more different variables that you need to take into consideration whilst you are trading. So please do not get into a habit of trying to put lines everywhere on your chart. This was something that I've done in my first year of trading. It's not going to help you in the long run. If anything, it's going to make your charts look quite messy. You always just want to make sure that you're identifying the key areas of reversal, combining it with your other technical analysis tools, such as your MACD, your candlestick formation as well. And based off everything combined, then you will be able to say to yourself, okay, I will now put a line there because that's definitely held up alongside everything else with all of my forms of analysis, meaning that that will probably be a valid area of support or resistance should price go back down to that point again. Every single one of these pages will allow you to understand exactly what it means when a price gets to a certain point and how you should deal with that or trade it once it gets there. So with all of these pages that I'm going to be going through, please remember everything needs to be used in combination with each other. So order blocks is basically what I would call a more advanced form of analysis of support and resistance. So basically what an order block is, an order block tells you or shows you where all of the big institutional funds or the banks or the hedge funds are now getting involved in the trades. So as I mentioned from our very, very first session, the way in which we want to trade, we are called retail traders. The reason why we're retail traders is because the money that we have or the investments that we generally have in the markets are nowhere near to the same degree or the same level as your hedge funds or your institutional banks as well. So retail traders generally make up a very small portion of the markets. So the whole point, in order for us to be successful when we're trading, is really try to understand where are the big institutions really pouring their funds. So with an order block, I'm going to share the chart again. As I said, we are going back and forth. What we need to try and look out for is the last bullish candle before a strong bearish move, which is what's called a supply zone. And then we're looking at the last bearish candle before a strong bullish move, which is also called a demand zone. So sharing my candle just to make you guys see exactly what I'm referring to. So what I would usually do, I would start off with my weekly. I'd say, okay, what is going on from a weekly perspective now? How is everything looking from a longer term perspective? After I identify what is happening on the weekly, I draw my trend lines, I do my analysis, and then what I want to do, I want to go through all of the different time intervals to understand what is happening on a smaller degree. So as I continue to go through all of the different time intervals, it would allow me to understand what is happening from a bigger picture as well as what's happening from a smaller picture. So by doing so, when I see an order block happening already in the back of my mind, I know that we're in an uptrend. So if an order block is happening and it's happening in the same direction as an uptrend, for me, that is confirmation that we're going to continue going up again. I would always say to you guys, always do what's called cross time frame analysis. Always start from your weekly, go down to your daily. From your daily, you want to go down to your 12 hour. From your 12 hour, you want to go down to your 4 hour chart. And after that, you want to go into your 1 hour and so on. Your 15-minute time frame is only for you to identify your entry point. If some people, like I said here, might be scalpers, so some people may not mind, trading off a 15-minute time frame or 5 minute time frame. But the way I like to trade, I like to understand how long can I stay in a trade for, meaning if I've identified a long-term trend based on a weekly time frame, can I stay in a trade for a period of a few days, maybe even go into a few weeks, because I've now identified that the price is potentially going to go up for a period of time. Again, like we said, we done a fundamental analysis session last week. If we're doing that alongside all of the fundamental news and the macroeconomic news and everything's pointing up, then of course it's going to be good confirmation for us as well. If you look at this order block that happened here, it broke out of this structure. Two, it created an imbalance because of the momentum of the candles previous to the ones that it created before. And three, it's created inefficiency as well. So the inefficiency means that the gap between this candle and this candle is what you call the inefficiency. So the inefficiency means that there was no room at all for anyone to sell it because the momentum and the buyer pressure was so strong. Generally speaking, when we see a lot of momentum, we see a lot of small candles, then we see a huge, massive candle. It's not really the retail traders that's creating that sort of price action. It's the big banks or the institutional funds that's creating that sort of price action. So because of the huge gap that we saw here, this is what we take as a sign that we're potentially going to get more buys. But as I said to you, you want to make sure that it's in the same direction as the trend. You want to make sure that it's broken out, it's clearly broken out of a structure or corrective formation that you've had. And you want to make sure that it aligns with your either your candlestick formations or your other form of analysis that you're using. So the way we will trade is that we may be able to see an opening even before this huge move has begun. If we can get in before this has begun, then we're laughing. We've obviously taken advantage of this whole move here. But generally, if a trader hasn't been able to take advantage of that and they want to use that as a sign for the markets to keep going up, what they'll do, they'll look for other entries to continue to buy in the same direction. So as you guys can see here, we had a huge move to the upside. So now that we've had a huge move, what we're going to be looking for. So in Elliott wave terms, we would call this an impulse. So this is an impulsive move. So an impulse usually follows after a correction. After every correction, you're always going to get an impulse. And after every impulse, you're always going to get a correction. So now that we have this gap that's happened in the markets, or what would be called an impulse as well, we're now going to be looking for other opportunities to buy it. So how do we identify other opportunities? We're now looking for more corrective formations. So the corrective formation that we're looking at now is the slowing down of the markets. After whatever comes up, it must slow down. So this whole formation is what would be our corrective formation. Once we've identified our correction, we're now looking for another impulse to the upside. Now, because of this order block that's been created, this here, as I said to you guys, generally speaking, would be the beginning of a trend or the continuation of a trend. In this case, this was the beginning of a new trend, that order block that we saw. So we'd enter there, and as you can see, as you entered, the price has continued to stay above this point. So where you've got this order block, this would also be considered a strong area of support. So supports are usually very strong and very key whenever we've had an order block. If the price has moved up slow, but in a corrective formation, or it's done like loads and loads of small little candles, that probably wouldn't be a very strong area of support. But because we know it's an institutional fund that triggered that buy, we can actually say, okay, this could actually be a good area of support now. So now we've got our key area of support. We've got our order block that's happened. We've got our correction that's happened after the order block. If we haven't been able to get in at this point here, now we're looking for other points of entry, buy entries from that point onwards. So here would have been your buy. Of course, this is what's called a ranging market. But as you can see, since you bought it there, it's only come back down to that point once. And since it's come back down to that point, what's happened? Price has continued to move to the upside. Now, of course, we need to keep tracking it and we need to understand what sort of structure is forming over a period of days, hours, days, and weeks. But what we can see from this point onwards is that if you wanted to stay in a trade for, let's just say, a couple of hours, remember, we're on an hour time frame. This here would have been a nice trade for a few hours. Again, you've got the cheat sheet there. So it's just for you to make sure that you reference the cheat sheet whenever you can, because everything I'm saying needs to be, you need to remember it. Literally, if you don't remember it and you miss one thing out, that could be the difference between a good trade and a bad trade. So again, the order blocks must meet four rules. So imbalance, break of structure, inefficiency, and it must be unmitigated as well. As you guys saw, since it broke out of that order block, the price has not even come back down to test that zone. So you can tell that's already an order block. Another form of analysis that is very fundamental and will make a big difference in the way in which how we trade is trend lines. We need to always constantly be identifying trend lines every single time we trade. If we're not trading and trying to identify trend lines, again, it's going to make life very, very hard for any of you guys who do want to trade. So, what is a trend line? There's a saying in the markets which says the trend is your friend, meaning that if something is going to the upside, you always want to follow wherever it's going. Never, ideally, you don't want to be trading against the trend. It's never wise to trade against the trend. Generally speaking, if you do see a correction happening after an impulse, which is part of a trend, if you are going to trade that correction, don't be prepared to not stay in it for a long period of time. It's always something that you're going to be doing over a very short period of time. So a trend line in its most kind of basic format has to have a minimum of either an upwards trend has to have a minimum of two higher highs. So that's one high and that's a second high. Once you've got the two higher highs, you can now consider that to be a trend line, but that's a upwards trend line. In a downwards trend, you have to have a minimum of two lower lows. So when you're in a downtrend, which means a sell-off, you'd have a low, retracement, then a lower low again. The moment you can confirm your two lower lows, you now have your downtrend line. So that is really how we identify trend lines. That's basically in its most simplest form. So what does a trend line look like when we're looking at price action as well? So going back to our chart again. So let's take Wall Street, for example. So let's go on the long term. Let's say we go on a weekly chart. So as you can see, what is happening here, we are in a uptrend. So this would be the beginning of our trend. We've got a high here. So we've got one straight line to the upside. That's a high. Then as we can see, it breaks. We do a low. We can identify another high. And then it breaks again. It does a low again. And then as you can see, it goes up again. So this is what we would consider a uptrend. Now, because we've got a minimum of two higher highs, the moment we've got this second high here, we can now draw a point from here all the way to there to confirm this as an uptrend. So that is literally the basics. Now, what we'd do as traders, we'll basically carry out the exact same analysis across every single time frame to identify what trend are we currently in. So we know on a weekly time frame we're in an uptrend, it's clear as day. We've got a minimum of two higher highs, so we're clearly in an uptrend. But what happens if we go to our daily time frame? Again, we can see we're still in the uptrend on the daily. So we've got our trend line here. That's our trend line. So we've gone up. So that's one up. So we've touched it. We've gone up again. This is our second one. We've come back down, touched it again. As you can see, it tried to break out of it, but it didn't. It respected it. And now we're back up again. So what we've essentially got is 1, 2, 3, 4, 5 different waves potentially within this trend. What you guys are going to be trading is what is called Elliott wave theory. Now, within Elliott wave theory, what Elliott wave theory dictates is that you will always have 5 waves within a trend. You will never have anything more than 5 waves, whether it's in your large intervals, such as your weekly or your daily or your 4 hour, your 1 hour, you will always and only get 5 waves within a trend. In a trend, with your 5 waves, there's 2 different waves that we have within it. So this is what's called a motive wave. But within a motive wave, you get 2 different types of wave. You get one which is called a impulsive wave, and then you get a second one which is called a corrective wave. So an impulsive wave is very strong. As I said, is usually triggered by a order block or other sorts of analysis. After you get that wave, you will always get a correction. Once we identify the correction, as I showed you guys before, you'll always get a breakout of another impulsive wave again. You guys saw the example that I gave you on Euro USD when we had the massive order block. We had a little correction and then it broke out again, and since then it's been going up. And that is generally how it works. Now, 1, 2, 3, 4, which is usually corrective again. Now, when you get your 5th wave, 9 times out of 10, after your 5th wave, you get a reversal. So as you guys can see here, this would be our trend line with our first wave, which is impulsive, second, corrective, third, impulsive again, fourth, corrective, fifth, the last impulsive wave. Once you get the 5th, what would generally happen is that we'll get a breakout. And then once we get a breakout, it would start going back down again. And depending on what sort of time scale you're looking at, it would either break out to create a bigger trend, or it would break out to create a reversal and a trend in the opposite direction. So that's a very, 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 very important thing for everyone to consider. And the reason why I say that is because some people, when they see trend lines, what they do is this. They say we've got a wave up, down, up, down. They say that, and they say, oh, we've got 2 higher highs. And now because of that, I believe this is going to keep respecting the trend line. So they trade like this. And they say, oh, it respected it before. So because it respected it before, that must mean that when it comes down again, it's going to respect it again. And then they keep doing that, thinking to themselves that the trend, because it respected it before, is going to continuously respect it, where that's not how trading goes. And that's how wave theory analysis will always have an edge over people who only trade with trend lines and trend lines, but without the understanding of Elliott wave theory. Because Elliott wave theory dictates that you will always and only get to a maximum of 5 waves. So if that's the first wave, and that's the second wave, that's the third, this is the fourth, and this is the 5th. What does that mean? If we only get a maximum of 5 waves, it means all of this, that's void. That's probably not going to happen. Scratch that out. So whilst other traders are looking at that and thinking, oh, let me buy, as an Elliott wave theory person or someone who understands the basics of Elliott wave theory, you are now looking at that as, okay, the trend is probably going to break. We're looking for another correction. After we get a correction, we're probably going to go down even more again. That, in its basic format, is how you guys want to be trading and how you should be trading. always try to understand the waves. Now, of course, I'm going to be providing analysis, I'll be providing support. It will be hard to grasp when you first start. It's not easy, which is why a lot of people do not trade Elliott Wave and they try to trade it the simpler way. But once you do grasp that, I'm telling you, the edge you will have over many other traders will be second to none. This is the USD JPY. So within the USD JPY, we've got one up, one down, one up again. Because we've got that, we've got a minimum of two higher highs. So what that means is that we can now say that's our trend line. There you go. It's that simple. Same way if I do it like this. So this is a downtrend. We've got one down. We've got one up, one down again. So we've now got two lower highs. So that's a high and that's a lower high. Because we've got two lower highs, we now can identify this as our downtrend. As you guys can see here, once it broke that down, so once it broke that downtrend, what happened? It corrected outside of it. And after correcting outside of it, after it broke it, what did it do? It's now gone up to create an uptrend. Now, why is this important that I tell you this? Because by understanding how trend lines work, it helps us to understand where price is potentially going to go in the future. So you guys have clearly seen one up, one down, up, down in our downtrend, one up, down, up in our uptrend. What do we think is going to happen here? The likelihood is that at some point the price is going to come back down here again to retest this trend line. That is the likelihood of what is going to happen. So that's the beauty of understanding how trend lines work. Because now that the price is doing all of this over here, if it does go up, we know it's probably going to come back down here to test this point. Will it break it? Not sure. Could this be a 5-wave count? 1, 2, 3, 4, and back up again? Possibly. Will it break it and continue going down? We don't know until it gets to that point. But what we do know is that we have confirmed a trend line because we've got two higher highs, meaning that once we do anticipate it at some point to come back down to this trend line. So that is how the trend lines work. When you are identifying a descending trend line, you always want to put your line at the top part of the trend line. The reason why you want to put your line at the top of a descending trend line, with a descending trend line, you always want to look at the lower highs. And the reason why you always want to look at that is because you are looking for the price to potentially to break it to the upside, which is what it's done. When you are identifying a upwards trend, you always want to put your line at the bottom of the trend line, like this here. Never put your line at the top here. Unless you want to look at a channel, this is what's called, you're now looking at channels. But if you are looking at a trend line, this is incorrect. So this is an upward trend, that's incorrect. You're always going to put it at the bottom. You're always going to identify the higher highs, and your line will always be at the bottom of the trend. Very important for all of you to understand that the best way and the only way you guys are going to pick up what I'm saying is by doing it yourselves. There's only so much you will be able to understand just by watching me do it and showing you the theory and scrolling back through a few charts. As we continue to progress, I will be getting you guys to do quizzes. I will be getting you guys to identify corrections and impulses, patterns and trend lines. And I will need you guys to send all of your trend lines, all of your patterns, everything that you've identified into the group, the course group. At the end of the day, don't shy away from doing it. Yes, you're going to get it wrong, but that's the whole, that's the point of this whole process, that you get it wrong first. And the more you continue to practice, the better you get. And the more everything will just become clear as we move forward. But definitely make sure that you've got your, if it's not TradingView, it has to be MetaTrader 4, but make sure you've got your technical analysis tools available to you. and I'm going to be basically giving you guys requirements throughout the week and asking you guys to send me. For instance, I might say Euro USD daily time frame. Please identify all of the different trend lines you see on the daily time frame and take a screenshot and send it in a group. And that's the only way we're going to make sure that you guys can progress and progress properly as well, alongside with the Fibonacci, the patterns, and the candlesticks as well, everything that we've seen. Now we are onto chart patterns. So with chart patterns, that is probably one of the primary tools that we're going to be using to identify our corrective formations. So with a chart pattern, generally speaking, is something that we have to identify that follows after a impulse. So as I said to you, after you get an impulse, I think maybe I can write it here again. Yeah. So when you get impulse, whether so let's just say here you get impulse up, you're always going to get a correction all the time. Yeah, that's fine. So with a correction, your correction is always going to come in a form of a pattern all the time. Now, there's different patterns that we need to identify. I will send you guys the pattern cheat sheet as well. And those patterns is what's going to help you to understand our best times to get into a trade. So if you've got impulse here, you've got a pattern. The moment you've identified that, once it breaks out of that pattern, now you're looking to buy it to the upside. Again, if you've got impulse a sell and you've identified a pattern, the moment you've identified that and it breaks it, that's going to be your area of entry to go in for the sell. That is how we trade. That is literally how we trade. Is that, well, I say it's that simple. It's not that simple because this is where it becomes a bit, some patterns are very, very hard to identify. And within Elliott wave theory, we have a one, we usually have a one. Then we have the pattern, which is usually identified as A, B, and a C. And within the ABC formation, sometimes what it does, it creates an even more complex pattern and it prolongs it before it decides to go back up again. So best case scenario is that we get a simple pattern that we can identify. It goes to the upside, we buy it, all, amazing, great. But sometimes what you will see is that with the ABC, it will break out and it will do another ABC again, and then it will go up. And when it starts doing moves like that, sometimes you will get confused. And when we start seeing stuff like that, what we do, we call it a X, Y, and a Z. When it starts to, I mean, again, you guys, I've put the wave theory book in the group. What I'm explaining now, until you start committing yourself, remember the first thing I said when we first started this whole lesson plan is that the ones who commit themselves to the learning are the ones who become successful. There's no point me putting all of these resources in a group chat if you're not going to spend at least half an hour a day making sure that you brush up your knowledge on that. But the moment you do that every single day, the moment everything I'm talking about becomes so much more easier when I'm discussing it. So I'm going to show you a few charts which basically shows all of the different patterns. Not well, not all of the patterns, but it gives you quite a big idea, a clear idea of the sort of patterns that I've been trading with over the period of years to help me identify traits. Okay, so this is a trend. This is a channel that I've got a descending trend line. So we've got one down, we've got one up, we've got a down again. This is the impulse that we can see here. This is the correction. As I said to you guys already, we always get a correction after every single impulse. So impulse, correction, We've got another move to the downside. This is the bigger channel that I've identified. As you can see here, it's gone down to this point. It's created this channel here, and it's gone to the upside. Once it's gone to the upside, we've got a it's broken out of this trend line here. Now we've broken out of this trend line. As I said to you guys before, after every impulse, we get a correction. So once we've got the breakout here, this is the corrective formation here. So you're looking at this correction to give you more signs for the buy, for it to continue going up. So we've got the breakout, impulse, correction. So this would be an A, B, and a C. Once it breaks there, that would be our entry to go for the buy. Every time it breaks out of correction, it usually does a smaller correction after. Here, the price is correcting again to create more moves. Remember, we've broken out of this long-term trend line, so it's creating another move again to go up. And as we can see, that's the move it's created. So this is another correction. So remember, impulse, correction. What are we expecting after that? The correction, after every impulse comes a correction. We're looking for a breakout to the upside. And I'll show you what it's done after that. That was the result. So we've got the impulse, we've got the correction, it broke out of again, and it done another impulsive move to the upside. So that is basically how you guys are going to learn how to trade. But again, you're going to have your order blocks, your candlestick formations, your Fibonacci, all of that. That's going to coincide with everything that I'm showing you now. But the main thing you're going to be looking at is where is the impulse, where is the correction, and what direction is it going to break out into after we've got our impulse. So this is Germany 30. So you've got the impulse to the downside. So as you can see here, usually once it breaks out of a formation, it does a retest. That's the retest there. So that's kind of giving people an opportunity to go in and sell it. After that retest, we've got an impulse. After that impulse, as you guys can see how I'm saying, watch this area. We've got a 1. So this would be called the A. This should be the B wave. And then what are we expecting? Some sort of C wave, something like that. Once it confirms the C wave, we're looking for this to turn into something like that. And we're looking for a break to the downside. That's our best case scenario. So remember this chart, what I'm showing you now. So that's what it was doing then. And then that's what it done after that. So remember, that's the same place. So remember, that was the same retest, the same A, B, and this ended up being the C wave. And what did it do? Went all the way down. So impulse, corrective, impulsive. That's literally it. The only thing we've got to do is identify what sort of corrective formation are we trading within. As you can see here, let me zoom in more. If you can see, there's a doji at the top of here. Like I said to you, what does a doji represent? A doji represents indecision within the markets. So because we got a doji, we then started to go down for our B wave. Because we know this is probably making a corrective wave, we know it's probably going to go up again. Now, when it went up again, what did we get here? We got all of these tiny, tiny little green candles. Then we got this big red candle that popped up. That is a bearish engulfing candle. You guys will know this as you continue to reference the PDF. What happens after a bearish engulfing candle? Generally speaking, if we get a bearish engulfing candle within a correction in the same direction as the trend that we're looking at, we're using that to confirm the analysis that we already have. So we had a bearish engulfing, it done a fake breakout, but at that point when it goes to retest, this is where you would have probably gone in for the sell. You would have either gone in for a sell at the break of that trend line there. There would have been a very tiny trend line there, or you'd have gone in for a sell when it broke this corrective formation. Whenever you went in for a sell, your stop loss would have been anything above this point here. And then as you can see, you've got the sell-off going from there. So all of these, by looking at all of these formations, you will feel more and more confident in the trades in which you're taking. So US 30. So we've got an ascending trend line here. We've got a corrective formation here. We've done a correction. If we look at the result, boom, come all the way down and even broke past that channel as well. Why? Because after every impulse, you get a correction. Remember, if there's anything you're going to remember the trend is your friend, and after every impulse, you get a correction. If you remember those two things, life will be a lot more easier for you as you continue to trade. So that's that. Let's go back to the document. Is there any questions that any of you guys have? Please feel free to unmute your mics and ask me any questions. No questions at all?
No, I was gonna ask you, see, like previously, when something's going on like a downtrend, like it's getting to that end bit and it's dropping, have you like stuck in the trade or like give up the trade? Like what have you done in your experience? Like,
So wait, so are you referring to this here?
yeah, so you see that little end bit, like you see where you see that the second top line?
This one here?
Yeah.
Yeah.
So it's like when you're looking where it gets to like the height there and then it starts to drop. When it starts to drop, do you stay in the trade or does sometimes have you checked out of it and then sold or
So
where it is?
speaking for this one, because this was the impulse,
Yeah.
I had this as a correction,
Mm-hmm.
waiting for it to go to this area here,
Okay.
this area. That's where,
Yeah.
so that's where I'm looking to sell it right there. Because I've got this and I want to wait for the break. Remember, when we identify a correction, we either want to get in at the very top of the correction, which means that we can do more pounds per point and have a smaller stop, or we want to get in at the break of a correction. So
Okay.
getting at the top, we want to identify the trend line. So that's the trend line there. Once it breaks that trend line, we'd probably be going in at that point. If we've not seen that trend line, we want to get in here. So we're in this particular chart, we're looking at a sell. The sell is
Mm-hmm.
what we're looking at.
Okay.
Oh,
All right. Thank you.
nice. So within our chart patterns, some patterns might come as a flat like this. So if you're getting a downtrend, you might get something like this, which is called a channel and or a flag. So if you get a flag or a channel, it's usually very straight, very parallel. Once it breaks it, you either go for the sell or you want to go for a sell at this point here. Remember, but you're always looking at where has it come from? Where's the impulse? Where it's come from before? If it's not a channel, you get a triangle. So triangles come in that formation, so they squeeze. So within a triangle, it's the same sort of formation. So you get the impulse, you get the up, down, up, but it usually condenses as it continues to go within this pattern. And then once it comes down, it's the exact same thing. You're looking to sell it again. So that would be a triangle, guys. Everything I'm saying, you will have the PDF, which will allow you to see exactly what every single pattern represents. And then you will have another pattern, which is called a rising wedge. So it's all this, it's the same thing. I mean, what it means essentially is when you get a correction, no correction will always look the same. That's probably the best way to interpret what I'm saying to you guys. You're never going to get a correction that's going to look exactly the same as another correction. So, you might get a correction that looks like that, where it's like it's a triangular correction. You might get a correction where it's just a channel, where it's just a very flat correction. You might get a correction where it's, say, a pennant, sorry, or ascending wedge. You might just do like that and goes back down again. You might get another correction where it looks like it's descending, like this. But regardless of what it looks like, the fact remains is that after every impulse, you get a correction, and with the correction, considering it's a continuation, it will usually fall in the opposite direction. Now, with a reversal, reversals are slightly different. So reversals is something that we want to kind of combine with our Fibonacci tool. As I said to you, the Fibonacci tool identifies your key areas of support. It also identifies your key areas of resistance. And your reversal pattern formations, you also want to combine with your trend line. So as I said, if we have 5 waves within a trend, 1, 2, 3, 4, 5, usually the way in which you can tell that the fifth wave is coming to an end is that you tend to get a reversal pattern or formation within the fifth wave. So if you are going up and you're in the fifth wave, what you will get is reversal patterns that look like this. So it might be a double top. So for instance, if it's a 1, 2, 3, 4, 5, within this fifth wave here, what you might get if you're looking at it from a chart perspective is that it will go down. So we'll get to this point, go down. It will try to retest that point again. And then from it retest that point, it will fall off. In this case, it will break your whole trend line and fall off. This is what's called a double top. Double top is when you have 2 tops, basically meaning that it's tried to retest it, it's failed, and it's fallen off. So I'm going to show you a chart. Again, I much prefer to show you guys charts because it just makes more sense when you're looking at a chart. What we can see here, we can see a clear break of the trend line. So this is our trend line here. Oh. One thing you'll notice about double tops as well is that it doesn't have to go exactly to the same height that it went to before. So just because it went here does not mean the next double top has to go exactly to that area of resistance. So a double top can fall slightly below it, but this would still be considered a double top. So what you can see here is that it's broken out of this trend line. This was the correction. So you would have got involved here when it broke out here. This was the impulse. It's gone all the way back up, tried to go near to the previous high before it broke out of, and it's fallen again. So this is what you would call a double top. So a double top is when you've got basically 2 tops and it's topped out, and then from then it's just resumed its trend or the reversal in the opposite direction. Now, when you're looking at head and shoulders, a head and shoulders is basically when you're in an uptrend, it's at its final point, it's broken it. It's gone a little bit higher again. It's tried to come back up to the previous point where it was before, but it's not managed to go to that previous high, and then it's continued to go back down again. Let me not complicate it for all of you guys. I think the best thing to say is that regardless of what you want to call it or what people call it, where simply once something is broken out of a trend line, you can anticipate it to correct and try to retest it again. But once it tries to retest it again, we know that retest formally should be known as a correction. You can anticipate it to continue in the direction in which it was supposed to go in the first place. So regardless of whether you want to call it a heads and shoulders, a triple top, a double top, whatever it is, all we're essentially saying is that sometimes when something breaks out of a channel or out of a trend line, it's not always going to be as clean as what we want it to be. So as you can see here, ideally it broke out of this. We'd want it just to keep going down from here, but that wasn't the case. The fact of the matter is that it did come up to test these previous highs, basically near those previous highs, before it resumed its trend back down again. And that's simply what you'll get. Now, some people call it a double top. Some people, like myself, would just say that it was a deep pullback or it was a corrective formation back to the top again to stop everybody out before it continued to go back down again. So don't get too tied down into the naming conventions. I know I'm telling you the naming conventions now because those are the official names, but once you understand the name, the main thing that you need to understand is, okay, well, what does it mean? There's no point saying, okay, well, something's a pennant, but you don't know what it's going to do once it creates a pennant. If it's a pennant, it's more important that you understand that a pennant is a corrective formation which is followed by an impulse instead of saying that that's a pennant for the sake of it being a pennant, if you get what I mean. So try to understand the concepts behind it and what follows after it, rather than just getting tied down into the naming convention of what it is that I'm going to be teaching you guys or you're going to be reading within your books. I hope you understand that, and I hope it's clear for everyone. So one thing that you will find is that in my analysis that I post is very, very clean. I don't overdo it. I don't try to identify too much things, because the more technical tools you add to it, the more, if this thing is in your favor, the other tool isn't in your favor, you're going to hesitate, and then before you know it, you're probably not going to want to take the trade, simply because things were your different forms of analysis was contradicting yourself. I usually say that if most of your forms of analysis is pointing in the same direction of a buy or sell that you're anticipating, then take it for what it is. It's going to be very, very rare that every form of analysis from your trend lines to your pattern identification to your candlestick formation to your Elliott wave theory, it's going to be very unlikely that every single one of them is going to point in the exact same direction. More often than not, you're going to get at least one that's going to say the opposite of the other four or the other three. But trading works in probability, and you always need to ask yourself, well, based on probability, what is it saying it's going to do? If the probability is saying that it's got 80% chance of going to the upside, then go with that probability. If you get 100% trade where every single indicator is pointing in the exact same direction, I mean, yeah, that's amazing. To be honest, I've been trading for about 15 years, and I've only had that happen to me. I could count them up probably about, I'd say no more than 10 times. I've had every single indicator pointing in the exact same direction. And all the other times, it's literally just been three have said yes, two have said no, or maybe four have said yes and one has said no. But you need to go, there's other form, you need to go with your intuition. You need to make sure that you're going in the direction of the trend, and you need to make sure that you've identified the impulse. Therefore, you know that this is the correction. Once you've identified those core things, then it becomes easier for you to take your trade. You've got to be prepared as well. So make sure you do your journal, make sure you mark all of your setups before you take it as well. So every single thing that you do I tend to do my analysis on a Sunday. So I look at the fundamental news on a Sunday evening to make sure that I'm alert of any big market movers or any big things that's coming out. As I said, press conference, non-farm payroll, anything. And I'll also do my analysis as well. So once I come off this call, I will be doing my analysis. That is a routine that I do have. And I'll make sure that I can identify what's happening from a long-term perspective as well as a short-term perspective. So always do your analysis ideally at the beginning of every week. And again, always use a checklist. Make sure there's confluence. So make sure your fundamentals and your technicals and timing is aligned with each other. And there has to be a minimum of two that's been ticked. If only one is aligned, then don't trade. So if you've got your technical and your timing aligned, great. If your fundamentals and your technicals aligned, then great. But if it's only just your technicals that's there, but your timing isn't there and the fundamental isn't there, then I'd probably say, trade it very, very carefully. But you need to make sure that most of your tick boxes are in agreement with each other before you take a trade. And I'd always say risk small as well. So myself personally, I risk about 5% personally. But I do that because I've been in the markets for such a long period of time. For you guys just starting out, you should be risking 1 to 3% absolute maximum, no more than 3%. So I will show you in further lessons how to calculate your risk to reward to make sure you're only risking 3%. But I shouldn't really be seeing anyone risking anything more than 3% because you will make mistakes. There's going to be some times where I won't be able to provide that support. I might be doing something and you might see a trade that you think is a great opportunity to get involved in, and you just might want to take it. You might do a silly mistake. In the beginning of trading, there was times where I identified a setup, I went into the trade and I accidentally pressed buy instead of sell. I've done some of the most stupid things. So I'm not saying you guys will do it, but just be prepared for the fact that you are probably going to be prone to making more mistakes as you start trading. And also accept the losses as well. Again, everything works in probability. So if out of every 5 trades, you're making 4 successful trades, then that's good. If you're doing 8 trades out of every 10 trades, only 8 is successful, or 7 is successful and 3 are unsuccessful, you're still doing good. That's the game. That's the game we're in. That's what trading is all about. It always works in probabilities. I've never had a year where I've won every single trade. Never. I've always lost trades. I've won more, but because of my risk to reward, that's what allows me to have the edge and to be able to stay in the game. Also, no trade is better than a rush trade. So again, if you don't force it, make sure that you're doing your analysis. If you don't see it, don't go in. Just because something is moving, let's just say you've had a order block, an order block. Don't try to chase that order because you think it's running away. This is similar to what I said to last time. You know, just try to, if you've missed it, try to wait for another entry. The markets always gives you opportunities to enter all the time. So that's what I would leave you all with. Again, I advise every single one of you to download TradingView for your 30-day free trial as soon as possible. If not, use MetaTrader 4. And when you are using it, give me the heads up because I'm going to start asking you guys to do some analysis this week. And I want you to identify trend lines. I want you to read up on the pattern identification. I want you to read up on the candlestick formation. And I'm going to say, guys, show me, identify all of the dojis, identify this, identify that. And I want you to post your chart in the group. If you do not post it in the group, then I assume that you're not committing yourself the way you should be committing yourself. Remember, I had to trade for at least 3 years before I could be somewhat successful or consistent. 3 years it took me. I'm hoping you guys can do it in 6 months, but it all boils down to how much time you commit yourself to these charts. And that's all I can say. So that's the end of the session. So I hope you guys digested everything. I will send this PDF in the group. One very, very important thing I must add as well is that you need to have Vantage. You need to have your Vantage broker. You need to have your live account and your demo account. Vantage, their 150% offer does finish at the end of this month. You should either have that link that was sent in a group or that link that was sent directly to you from me. So if you don't have that, then it's going to be hard for you won't be able to commit to next week and the future sessions that we're doing. So before next week Sunday, please make sure if you haven't got your Vantage account set up your Vantage account through the link that's been provided in the group and make sure that you're ready to start putting on demo trades through Vantage because that's how we're going to be trading. And then once it comes to trading live, at least your live account's there. So yeah, let me know if I don't see Vantage, you won't be able to participate next week. So make sure you've got Vantage set up. That's everything for today, guys. Have a good evening.